All right, let's talk about one of the most exciting, most talked about events in the business world, the IPO. You know, the initial public offering. We're going to dive into how a private company just explodes onto the public stage and what that actually means for, well, for all of us.
So what's with this huge number? Plus 618%. That right there is the mind-blowing return for some of the first investors in Reddit's IPO just this year. I mean, a number like that, it doesn't just make the news, it literally creates fortunes. Overnight.
So it makes you wonder, right? How does this even happen? One day a company is just a private brand we all know, and the next, poof, it's got its own stock ticker. And really, the question we all want to know is, could it make you rich? Is jumping on these big IPOs a genius move or just a huge gamble? All right, let's get into it.
Okay, so first up, what is an IPO, really? It's not just about getting a stock ticker next to your name. Think of it more like a total transformation. It fundamentally changes the DNA of a company.
I mean, the name says it all, right? Initial, public, offering. It's the very first time a company offers its shares to, well, the public. It's kind of like a company's big coming out party, you know? It's the moment it steps into the spotlight and says, hey world, you can own a piece of us now.
And this is where everything changes. See, when a company is private, ownership is a super exclusive club. You know, just the founders, some early investors, venture capitalists. But after an IPO, bam, the doors are thrown wide open. Anybody with a brokerage account can get in on the action. But, and this is a big but, going public means you're living in a glass house. You have to report everything to regulators like the SEC, and you're under a microscope 24/7.
So why on earth would a company sign up for all that scrutiny? Well, it really boils down to three huge motivations. Number one, and this is the big one, money. A ton of cash for growth and expansion. Number two, it's payday for the early believers. All those founders, early employees, and investors can finally sell their shares and see a return. And number three, honestly, it's about prestige. Being on the New York Stock Exchange or the NASDAQ, that's a huge stamp of approval. It screams, we've made it.
All right, so how does a company actually pull this off? It's not like flipping a switch. Nope. It's an epic journey, a really complex process that can take anywhere from 6 months to a whole year.
We can basically break this whole marathon down into 5 key steps. First, you got to hire the big guns, the investment banks or underwriters. Then comes the paperwork, and I mean a mountain of it, called the S1. After that, the execs go on a roadshow, basically a world tour to get big investors hyped up. From there, they figure out the price. And then, the grand finale, listing day. That's the day it all goes live.
So, step 1, hiring those underwriters. Think of these investment banks as the guides and gatekeepers to the public markets. They run the whole show, the advising, the paperwork, selling the shares. And you know, they don't do it for free. They take a pretty nice cut, usually somewhere between 4 and 7% of the total money raised.
Next up is that S1 filing. The best way to think about this thing is like a company's tell-all biography, written for investors. It's this enormous document filed with the SEC that has everything: how they make money, what their books look like, their big plans for the future, and maybe, most importantly, every single thing that could possibly go wrong. All the risks are laid bare.
Okay, now this next part is super important, and it's where a lot of people get confused. There are 2 different prices. You've got the IPO price. Think of that as the wholesale price that the big banks and hedge funds pay the night before it goes public. Then you have the opening price. That's the first price you or I see when it actually starts trading on the exchange. And that gap between the two, that's the famous IPO pop. And believe me, that pop can be huge. If you look at the data going all the way back to 1980, the average first-day jump for an IPO is about 18.4%. That is why you see all the crazy headlines. That's where all the hype comes from. But, you know, an average is just an average. The reality can be, well, a lot messier. So let's look at some real-world examples from recently to see just how wild the outcomes can be. We've got winners and losers here.
And wow, does this tell a story? Just look at this. On one hand, you have ARM and Reddit. I mean, just incredible returns. 125%, 618%. Insane. Instacart did pretty well, up 47%. But then you've got Birkenstock. Yep, the sandal company. It's actually down 17% from its IPO price. It's a total crapshoot.
So the big question is, how do you get a piece of the next Reddit and dodge the next Birkenstock? The tough truth is, for most of us, it's almost impossible. And it all comes down to one word: allocation. Check this out. Typically, a whopping 90% of the shares in an IPO are already spoken for by the big guys, the institutions. That leaves just a tiny 10% sliver for everyday retail investors. The odds are stacked. And that really brings us to the hard reality of all this. Once you look past the flashy headlines, you start to see that for the regular investor, the whole IPO game is loaded with risks that the hype machine just loves to ignore.
Now, this might be the single most important chart we look at today. Seriously. The first day pop gets all the attention, right? But what about the long run? Well, the data is pretty clear. Over a 3-year window, IPOs on average returned about 34%. But similar stocks that were already public, they returned almost 62%, nearly double. It just goes to show you that initial hype fades a lot.
And there's another risk you've got to know about. It's called the lockup period. Basically, for the first 6 months or so, about 180 days, insiders like founders and early investors are forbidden from selling their shares. But what happens when that lockup expires? Well, suddenly a whole flood of shares can hit the market all at once, and that can really push the stock price down. So because of all these challenges and costs, the good old-fashioned IPO isn't the only way to do it anymore. A few new, interesting alternatives have popped up.
The two big ones you hear about are direct listings and SPACs. A direct listing is what Spotify did. It's a way to get your shares on the stock market without paying those huge underwriter fees. Then you have SPACs. This one's a little wild. A SPAC is basically a blank check company that goes public with no actual business, just a pile of cash and a promise to go buy a real private company. Both of these had their moments in the sun, followed by some, let's say, serious reality checks.
So what's the IPO market look like right now? Well, it's kind of slowly waking up after being pretty much frozen solid back in 2022. No surprise, all the excitement right now is around tech and AI. And there's this massive backlog of huge private companies. We're talking giants like SpaceX, just sitting on the sidelines, waiting for the perfect time to make their move. Okay, so let's boil it all down. What's the one thing you should remember from all this? It's this. The IPO process, from top to bottom, is built for the big institutions. It's not really designed for the little guy. Your access is limited, and the long-term data pretty clearly shows that being cautious is a way smarter move than just blindly chasing that day one hype.
Look, IPOs are always going to grab headlines. The stories of people getting rich overnight are just too good to resist. But it leaves you with a really big question, doesn't it? If the game is kind of rigged against the average investor, maybe the real secret to getting wealthy isn't about chasing these shiny new things at all. Maybe it's hiding in plain sight, with the boring, steady, proven companies that are already out there. Just something to think about.